Okay. All right. So, as I mentioned to you guys last time I saw you, I did say we are now getting into learning unit 3. There. So that is exactly what we will be doing. Here's my chart. Okay. So let's just sit down a little bit, and we'll get this show on the road. Okay, so I'm gonna, if you look on VC Learn in your ICE tasks folder or ICE activities, you'll find that I shared with you 1 or 2 images or things there. That's for your first 2 ICE tasks this year or this semester, should I say. I'm only giving you 2. Sorry, 5 ICE tasks. Okay. So please make sure that you do all of them so that you make sure you have your minimum 4. Okay. Right. So I'm gonna give you your ISAs either today at night. I'll release them to you, the first 2 at least, and those are just based on Unit 1 and Unit 2. Or I will by tomorrow end of day will have organized that for you guys, and I'll make it to the end of what you call it, 31st of August. Yeah, so it'll give you enough time to get that done as well. All right. So let's get into these slides. Let's get into these slides. Right. Can you guys see clearly? It's too small, man. It's fine. Okay, it's fine. Right. So Unit 3, depreciable assets. Okay. Right. Now we are beginning 1. This is where it really gets. School begins now. So I gave you guys an out. There's no turning back from now on. Okay. All right. So non-current assets are resources controlled by the entity for longer than a year. This we know. As a result of past events, okay? We had to obviously make some deals in order to acquire these or have control of these non-current assets. All right. Now, we know that the pivotal characteristic of an asset is that it's going to give us a future economic benefit at some point in time in the future. Okay. So that's what these non-current assets are all about. And then we go on to see that it also says almost all non-current assets fluctuate in value. What do they mean? Over time, they either increase in value or decrease in value. Okay. Most assets, most non-current assets actually decrease in value. Okay. But there are some that actually appreciate in value, like real estate, vintage cars. What else? You have those baseball cards or basketball cards, you know, special sportsmen, all right, or sportswomen, right, that are obviously of value. For instance, like Michael Jordan or, you know, etc. Those things become valuable. So just things that then increase in value, that's they're appreciating in value. But most of them actually depreciate in value. In other words, they lose value over time. Okay? And what we call this loss in value is depreciation. Okay? So that's what we are primarily looking at in this learning unit. Okay? It says depreciation is an adjustment at the end of a financial year where we attempt to adjust the value of a non-current asset to the value that is generally referred to as the net realizable value. Okay, what is the net realizable value? This is the realistic trade value of the asset at that date. So in other words, it's just like you, when you know that you've bought a car, you've had the car for 2-3 years, you know that you can't sell the car for the same price that you bought it because you've been using it. It has depreciated, it has lost value. Okay? That net realizable value is now the price that you can realistically sell that car at. Does that make sense? All right, so just fancy English for simple things. Okay? The adjusted value is also referred to as the carrying value. So this net realizable value can also be referred to as the carrying value or the book value, okay? And is disclosed in the financial statements, in the balance sheet. In the balance sheet, you'll get the carrying value of whatever asset we are actually looking at. Also in the property, plant, and equipment statement. For those of you who've had accounting, you'll know what we're referring to. For those who haven't, don't even worry about it. By the end of this unit, you will see it. Okay? We will talk about it a little bit more in the slides, at the end of these slides. Okay. Then depreciation is classified as an expense account. Okay. What are we saying? Whenever we incur depreciation, we are going to debit the depreciation account, because that's how expenses behave. We know that whenever we incur an expense, we debit that account. Okay. And then obviously depreciation decreases the value of the non-current asset. NB, if the asset is only used for part of the financial year, depreciation is adjusted accordingly. Number of months asset was used. Sorry. So what are they saying here? They're saying that depending on how long we've had the asset for, we need to apportion the asset for that period. That's all that they're saying there. Okay. Right. Now, when it comes to depreciation, we have two methods. Two methods that we use. Okay. We have the straight line method. With the straight line method, depreciation is calculated on the cost price of the asset using a predetermined rate of depreciation. So they'll tell you your depreciation rate per annum is 20%. Okay. Then you just take the cost price and you say, okay, this asset is worth 100,000. 20% of 100,000, you have your 20,000 depreciation for that year. You get to year 2, you say, okay, we want to calculate depreciation again because we're at the end of year 2. Say 20% of the cost price, which is still the cost price which we had, is always going to be the cost price you had. Does that make sense? So 100,000 again, 20% of 100 is still going to be 20%. Can you see that? That's why we call it straight line, because the amount of depreciation is always going to be the same. It's straight. Okay. The applicable depreciation rate can be determined by estimating the useful life of the asset. What are we saying here? Does somebody want to explain? How do we estimate the depreciation rate using the useful life of the asset? If somebody tells you this asset can last you maybe 10 years, what are they saying? Is the asset valuable after the 10 years? It's not. We can't do anything with it, right? It's done now. So now, if we can't do anything with it after the 10 years, and we bought this thing, say, for 10 million, what's the value of the asset after the 10 years? If it can't do anything for us, is there any value? So it's zero, nothing, right? Okay. So now, this is how we begin to determine or estimate the depreciation rate. We then say to ourselves, okay, just want to go to this here. Okay. Okay, so I'm just going to talk about these. I already did the calculations with my earlier class. Okay, trying to zoom out here. Hey, this thing. All right, there we go. So, if the cost price of the asset is 10 million, right? Okay. Okay, no, this is not what I was calculating. This is not what I was illustrating or trying to illustrate now. Okay, we'll use that in just a second. I want to show you how you can get the depreciation rate. So let's say the cost price of the asset is, someone give me a number. What's the cost price of the asset? 1 million rand. Okay, nice and simple. Thank you very much, sir. 1 million rand. Okay, cool. We've got our 1 million rand cost price. And we said that this asset is going to last us 10 years. Okay? So I'm just going to say lifetime. Usually this is estimated. Okay? Because your use of the asset may be very different from my use of the asset, very different from his use of it. I could be using it intensely, him barely even using it, you using it semi-intensely. Does it make sense? Okay, so this is not a granted for everyone. Okay. So 10 years. Now we're saying after this 10 years, it's got zero value. So it's lost all its value. Does that make sense? So then we're saying, okay, so then what is the depreciation rate? Okay, we're then saying if this thing is losing its value, 1 million, yeah, that's 6 zeros, divided by 10 to find out how much value is it losing every year. We obviously get 1 mil, right? So then we say, okay, so what then is the depreciation rate? We obviously are saying 1 million divided by 10. You said, no, sorry. You said 1 million. So it's 100,000, my bad. Let me put 100K there. Okay, that is still 1 million. Okay, so we're fine over there. So we're saying 100K. Let me just do this in full. Divided by 10, which means we are losing 10,000 every year. Okay, so then we say, okay, cool. To get our, oh no, I'm doing something wrong here. Right, we said 1 million divided by 10, we get 100K. Then we said, yeah, 100K divided by, oh, this is what I wanted to do. 100K divided by 10, 1 million, okay? Because we want to find out the depreciation rate. Makes sense. That's 100,000. There's your million. There we go. And that gives us 10%. Okay, are we together in terms of getting the depreciation rate? Okay, I'm just going to go over it one more time because your lecture was lost for a second there. Okay, all right, so he needs to do this for himself. All right, so we said cost price, 1 million. Okay, we know that this has a lifetime of 10 years. Okay. After the 10 years, the value is zero. So we're saying, okay, cool. So how much value are we losing every single year? Okay, so that 1 million divided by 10, we get 100,000 every year. All right, so here we could even go per year if we wanted to. Right, then we're saying, okay, what percentage of depreciation, because we know depreciation is that loss in value of 100,000. So we're saying, what then is our depreciation rate? We're saying 100,000 divided by the total value gives us then our depreciation rate. So that's now just showing you how we can calculate or estimate our depreciation rate using the useful life of the asset. Make sense? Okay. And if you go through example 3.1 in your textbooks, you'll also see how they do that there. Okay. Now I've just chosen to not do that because that example is quite low. So I don't want to waste too much time, right? So let's get back to our slides. The next thing that we have, the next method that we have in terms of depreciation is then the reducing balance method or the diminishing balance method. It's the same thing, okay? Reducing balance method, diminishing balance method, same thing. Now, what's going on with this method? The annual depreciation is calculated as a percentage of the carrying value. Remember when we were doing the straight line, it was a percentage of the cost price. So this one is the carrying value of the asset. Okay, but what is the carrying value of the asset? We spoke about it a bit when we were talking about the net realizable value. Okay, the carrying value is obtained by deducting accumulated depreciation. So in other words, whatever depreciation has already occurred on this asset. Remember, earlier I gave the illustration of you've had a car for 3 years. Those 3 years that you've had it for, before selling it, there's been depreciation. All that depreciation for that period of 3 years is called accumulated depreciation. Does that make sense? Okay. Then we're saying, so that accumulated depreciation minus the cost price of the car then gives us the carrying value. Okay. Then, let me hide this quickly. Goes on to say, I hide one thing, another thing pops up. Okay, there we go. The depreciation rate is then applied to the carrying value to calculate the depreciation amount for the year. Okay, right. Okay, let's go back to our over here. So now this is just a different illustration. Okay. Yeah, a different example to illustrate accumulated. What is this? Reducing balance method. Okay. All right, or diminishing balance method. Okay. So in this illustration, we have a cost price of 10 million. We have a depreciation rate of 10%. They've given us the rate this time. We don't have to calculate it. Then to calculate our accumulated depreciation, our reducing balance method, we know that we need to take cost price minus your accumulated depreciation to get your carrying value. Then we say carrying value times the depreciation rate to get the depreciation. Cool, no problem. In year one, because we didn't have any depreciation, because we've just bought the asset. Does that make sense? So there's no accumulated depreciation. So we're saying 10 million times 0, accumulated because there's nothing, gives us 10 million. Then we're saying 10 million times the depreciation rate of 10%, which gives you 1 million. So our depreciation for year one is that 1 million. Happiness. Okay, we're all still together. Then in year two, we are saying, okay, this time though, we know that the cost price is 10 million, but we do actually have accumulated depreciation because we've had this asset for a year now, okay? Because we're sitting over in year two. So that 1 million depreciation that we had in year one, we're now saying minus the cost price to get our carrying value. This is the net realizable value, or the value we can sell this asset at, ideally. Because someone might say, I can't pay 9 million. I'm willing to give you 7.5. Tough. So 9 million times 10%, we then, can you see, get 900,000 depreciation for year two. And I'm sure now you can begin to see why they call it the reducing balance method. Because can you see your depreciation actually decreases as you go along. Whereas with a straight line, it was just a million, a million, a million, a million every year until we get to, okay, until we get to 0.
So depreciates the most in the first
year. Which one?
This one. This method.
Yes, 100%. It depreciates the most in the first year. The first person who's ever said that, and it's 100% correct. 100%. Okay. Okay. All right. So those are our two methods in terms of depreciation. Okay. let's continue with our presentation. Okay, then accounting entries. So once we've calculated depreciation, now we need to record it in the books. Okay, so after depreciation has been determined, the following accounting entries in the general ledger are used to record depreciation. Depreciation account we know is an expense account. Okay. Now I don't know why your textbook gives me headaches sometimes in this regard. They always like to start with the general ledger, but as you know, with the bookkeeping cycle, everything starts with the journals and then gets posted to the general ledger. Okay. So anyway, depreciation account is an expense, so there we're actually debiting the depreciation account. Okay. The contra account that we are debiting the depreciation account with is the accumulated depreciation. Okay. Now, accumulated depreciation, also known as provision for depreciation account, okay, is a negative asset. All right, it's a negative asset. What do we mean by a negative asset? Assets always increase on which side? On the debit. But you see, accumulated depreciation is special because it increases on the credit side. But now when you think about it, why? Why does it increase on the credit side? What is depreciation doing? What did we say the definition for depreciation is? It's a loss in value. So when our assets increase in value, we debit. So if we're saying our asset is actually depreciating, then we should be crediting. So can you see now why we say it's a negative asset? It reduces the value of our assets. Okay. All right. When crediting the negative asset account, one is actually crediting the asset account to which it serves as a negative asset. Okay. So in other words, they're speaking to the fact that for the vehicle that we were talking about, those 3 years that we've had it for, that accumulated depreciation is reducing the value on the vehicle's account. Does that make sense? That's what they're just trying to say there. Okay. Accounting entries. The annual depreciation is shown as an expense in the income statement, all right, or the profit and loss, while the non-current asset is shown in the balance sheet at the carrying value or the net realizable value. Okay. Remember that every double entry must be recorded in a subsidiary journal. The depreciation adjustment will always be recorded in the general journal. Remember with 1A, I know you guys are writing it not too long from now. The general journal is the journal we use to correct errors, to make adjustments, and for any other entry that would not be entered into the other 7 journals. So 7 or 8? 7, I think. 7 journals. Okay? The total is 8. Okay. So depreciation is entered in there. Okay. Asset register. Here we're just talking about a document that basically confirms what are the assets in the business. Okay. When were they purchased? Each asset, when was it purchased? From whom was it purchased? What is the serial number for that asset? Okay. Right. That's what the asset register is all about. Okay. And these are usually non-current assets there, and it's something required by SARS that every business has. And even when you've sold that asset, 5 years after you've sold that asset, they still want you to keep records of it until after the 5-year period has elapsed. Okay. The internal office memorandum or journal voucher serves as the source document for the entry. The supporting document is the asset register. Okay. Okay, cool. Right, so now we're not doing this today, but please take a picture of this and share it on the WhatsApp group. Very important. This is asset disposal. So we will talk about it, but we won't be doing any exercise in relation to asset disposal. It's basically just about whenever we sell an asset or trade in an asset, we would then dispose of it. And in disposing of it, what process, what must we do? Okay. Now, so here, okay, actually, let me talk to these steps quickly. Whenever we do dispose of an asset, step number one is we need to take the initial cost of that asset out of our books. So if you remember, we spoke about a car. We had it for 3 years. Bought this car, what price did we buy the car? 100K. So we bought the car for 100K. That 100K, when we first bought it, we recorded it in the books as vehicles and we debited 100,000. So in step number one, we need to remove that 100,000 from our books because we no longer have this vehicle. Does that make sense? So that's what we're doing. We're going to credit vehicles with that 100,000. Okay. Then we go to step number two. Take accumulated depreciation out of the books. So isn't for those 3 years that we had it, we had depreciation, we're recording it, and then obviously that depreciation has accumulated. So let's just say we were doing straight line depreciation, for the sake of keeping it simple, okay? And our depreciation rate was 10%. So how much depreciation did we have on this vehicle? 10,000 a year for 3 years, 30,000. So that's the accumulated depreciation, 30,000. Now we also need to take accumulated depreciation out of the books. So we know that accumulated depreciation, we've been crediting the accumulated depreciation account for those 3 years. So to take that out, we need to then debit the accumulated depreciation account. And here you can see debit accumulated depreciation. Then we're crediting asset disposal. Remember, every transaction or every entry we do, we need a double entry. So we use the asset disposal account to dispose of an asset. Even here, when we remove the cost price for the vehicle, we debited the asset disposal account. Did you see that? But don't worry too much about it. I just want to talk about it now. And then we'll actually do illustrations or examples when next time I see you maybe. I don't know how far we'll get. Step number three, record the sale of the asset, okay? So how did we dispose of the asset, okay? Did we do a trade-in, okay? Did we sell it for cash? Bank will be affected if we sold it for cash. Debtors control will be affected if we sold it on credit. And then obviously if we did a trade-in, then we will have creditors because it means we're going to be owing Toyota more for the new car that we've got because we're trading in isn't. So the car we are giving to Toyota, and then obviously they're giving us another better, newer, fancier car. All right, does that make sense? So that's why we're saying creditors control is then involved, okay, with the trading. Okay, and then obviously here, so we're going to debit one of these accounts depending on what the nature of the sale was, and then we're going to credit the asset disposal account. Okay. Okay. Then step number 4 is then to calculate, did we make a profit or a loss on the disposal of this vehicle? All right. How do we calculate that? To calculate that, you are saying, what was the carrying value of the asset? And then you're deducting it from what was the selling price that we sold it at. So we have had accumulated depreciation of 30,000, right? We bought the car for 100,000. So what's the carrying value of the asset? 70,000, okay? So if we sell this car for 80,000 and we made a profit or a loss, we made a profit because we sold it for more than the value of the car. However, if we sell this thing for 50,000 and we made a profit or a loss, we made a loss because we sold it for less than its actual value. Okay? And then obviously, so depending on whether you make a profit or a loss, so if you made a profit, you will then credit the profit and loss account. Okay. If you made a loss, you will debit the profit and loss account. Okay. And then you'll do the opposite for the asset disposal account. But you'll see this thing on a practical level. Okay. So I just wanted to explain the steps, and then when we get into that, I'm sure we'll explain them again. But at least theoretically, you've got an idea of what's that thing all about. Then here it says the following will be needed to calculate the profit or loss on the sale. So we need the selling price at which we are selling this thing, We need the initial cost price, the 100,000. How much did we buy this thing? Does that make sense? Then we need the accumulated depreciation. What has been the depreciation on this asset for the 3 years that we had it? Asset. Okay. So already, I'm sure you can already tell we were working with these as we were going through the illustration. Asset disposal. There will be times when a depreciable asset that is sold from a pool of assets, e.g. a group of company vehicles. In such a situation, there will be a depreciable asset left over after the sale. These assets must still be depreciated at year end. Okay, so what are they saying? We were just speaking to one car. All right, you guys might have also had your own cars, your own company cars. Let's just stick with company cars, right? So we sold his company car, but we kept the rest of yours. Can you see? And let's assume we sold the car at year end. Okay, we still need to calculate depreciation for all the other cars that we still have. Does that make sense? Okay. His car, we removed the depreciation, we removed the accumulated because it's no longer on our books. Remove the value of the car, everything. If the disposal happens at year end as well, okay, which is what we spoke to, it now becomes possible to combine the 4 steps of asset disposal with the year end adjustment of for depreciation. Okay. So basically what they're saying there is we can just calculate depreciation for all the vehicles and then just remove that or treat that disposal separately, all right? But the problem now comes in when we have an asset disposal midway or during the financial year, not at year end. Okay, this makes things a little bit more difficult. The only time depreciation is written off is either at the end of the financial year, no more year-end adjustment, or when depreciable assets are sold midway through the financial year. Okay, we only do depreciation, it's a year-end adjustment. So we only do it at the end of the year. But if we sold a vehicle, then we're forced to find out how much depreciation has taken place on that vehicle. Why? Because of those 4 steps. Remember, first we need to remove accumulated depreciation. So if we sold it 6 months into, so let's say we've sold it, we've had it for 3 years and 6 months. And you see we're already halfway into the new financial year. Okay? So in order to remove accumulated depreciation, we also need to account for that 6 months. So it'll be 3 years, 6 months. All right? And that's what then would force us to do depreciation calculation. Okay? Right. So in an ideal world, you'd always want it to be at year end when we sell something, but hey.
So how are you going to calculate the depreciation rate for that half year?
So you'd apportion. Your depreciation rate wouldn't change. What you would then say is, instead of saying we've had it for a whole year, you'd have to say 6 over 12 to apportion for that. Okay. All right, good question. Okay, so here a problem arises when the asset is sold midway through the financial year. Okay, I think this is really just speaking to what I've already just spoken to. Okay, so here they're just showing you that if we've had it halfway into the year, as I was speaking, you then have to debit depreciation, then credit accumulated depreciation, which is what we do anyway. And you'll see more of that. But then we also close off depreciation when it's at the end of the year. So here now they're saying your procedure will be slightly different if we are disposing of an asset prior to year end. Okay, so take another picture of this as well and share it on the WhatsApp. Okay, thank you so much. All right, so I won't go into this now, but it's pretty much the same process. Just 1 or 2 things that are different. But when we go through illustrations, or should I say exercises, we will do that together. Okay, right. So So now we're actually wrapping up. There's only 2 more slides left. So here now we're talking about disclosure of depreciable assets. Remember I spoke about the property, plant, and equipment statement that you get in your financials. And here they're saying at the end of the financial year, when a disclosure of the performance and position of the business takes place. Remember, we do performance via the income statement, position via the balance sheet, okay? The movements of non-current assets are clearly disclosed in the notes or notes to the financial statements. So the PPE is one of those. Okay? These movements are disclosed through the property, plant, and equipment note, okay? Which is the long-term or non-current assets section of the balance sheet, okay? So we do the property, plant, and equipment note in order to find what is the carrying value of our assets, because every asset will be found in the property, plant, and equipment. Does that make sense? So we'll probably have vehicles, one column for all our vehicles. We'll have one column for all our equipment, all right, and whatever other assets we may have, all right. If you go to page 82 in my textbook, I don't know what page it is in yours. It's also 82. There you will see an illustration of your property, plant, and equipment. Okay, and there you'll see when they're talking about movements, they're talking about, did we buy any vehicles? Did we sell any vehicles? Did we have any depreciation on that? How much was it? What's the accumulated depreciation? And so forth, so forth, so forth. Awesome stuff. We'll also do exercises on that towards the end of the learning unit. And if it comes in the test or exam, it's quite a few marks. But again, you can't do that if you don't know how to calculate for depreciation. Right. Cool. Any questions, thoughts, concerns? Nothing. Okay. So let's then go to, I want us to do exercise 3.1. And then if you can quickly just take a picture of that, share it on the WhatsApp group so that all of us can follow question 3.1. So very short, actually. Very short. You can also just take a picture of 3.3 as well, whilst you're at it. And we managed to do that? Has it been shared on the WhatsApp group? I'm saying, has it been shared on the WhatsApp group? Question 3.1. Not yet. Okay. Are you on WhatsApp? Can you share? Yeah, please. Okay, whilst he's doing that, I'm just going to start reading the required. Under required, it says prepare the depreciation and accumulated depreciation accounts in the general ledger of Nkwala stores for the financial years ending 31 December 2007 and 2008. And the second thing they want us to do is they say show the depreciation adjustments and closing transfers in the general journal of Nkwala stores on 31 December 2007 and 2008. Right. Again, we're going to start with the B because obviously We want to follow the bookkeeping process. We start in the journals, and then whatever we do in the journals gets posted to the general ledger. Okay, cool, awesome stuff. Then up top it says there, Nkwala Stores bought furniture for 67,200 on 1 July 2007. Okay. It was decided to depreciate the furniture at 20% per annum according to the straight line method. Ignore that and show all your workings. Okay, right. Okay, it's been shared on the WhatsApp group, right? Sweet. Thank you very much. Right. So the first thing we want to do here is we want to do our timeline. When it comes to depreciation, guys, it's critical that you have your timeline. Just so you know what it is we're actually working with, what are the time frames and so forth, so forth. Don't worry, this is the last thing that we'll do, and then I'll give you guys a break. Okay. So first thing, we know that we bought this vehicle, or we bought this, what is it? Furniture on the 1st of July. So 1 July, which is 7. Okay. And that was 2007. Okay. And then let's see. We want to do for the first financial year, it ends when? When does the first financial year end? No, that's when we bought it. We're doing this until 31 December 2007. Okay. And then we need to do another one up until 31 December 2008. Okay. All right. So I'm just going to use different colors here. You'll see how quickly things can get very complicated with depreciation. You can be doing several things at the same time. And that's why it's so important to do the timeline. Because then you know, okay, this is what I was trying to do as I was going along. Okay, so let me quickly just put. So this is the first thing. Let me call it A. Putting it in blue, and then this is then B, which we're doing in red. Okay, and that we're gonna calculate here. It's fine. All right. Okay, so let's quickly see here. Let me just zoom out a little bit. Okay. Right. So I'm sure you guys are tired, so let me just cut it here, and then we'll proceed as soon as you guys get that. Please let me be back by 11. Right, give me an extra 2 minutes, and then we'll wrap.